Reaching your first £100,000 is arguably the hardest and most important milestone in your investment journey. We'll dive into why that is in just a bit, but in this video I will walk you through the exact steps I am taking to hit that first £100,000 goal. I will explain what kind of investment account I use, what I'm investing in every single month, and more. So make sure to watch until the end. Okay, so I want to start by unpacking this quote from Charlie Munger, because it has some interesting takeaways. As you may know, he famously said that the first 100k is tough, but you've got to do it. But here is the interesting part. He adds, I don't care what you have to do. If it means walking everywhere and not eating anything that wasn't purchased with a coupon, find a way to get your hands on £100,000. After that, you can ease off the gas a little bit. Interestingly, the second part of the quote suggests that we need to save and be frugal to reach 100k as quickly as possible, rather than focusing on finding the best investment options. Charlie doesn't mention investing in gold or any specific stocks. As a side note, this quote was made in 1998, which means that when you account for inflation, that £100,000 or dollars is actually about £220,000 today. However, the key takeaway is that the principle for achieving this remains unchanged. Contrary to what people typically believe, the first 100k is not usually derived from investment returns. Instead, it's derived from your contributions. For instance, if you invest £300 each month for 15 years at an 8% return, you would accumulate about £104,000 by the end of that period. 52% of that amount is made up of your own contributions and 48% from interest. If you keep investing the same amount for another 15 years, by the 30-year mark, you could reach £450,000. But what's fascinating is that by that point, 76% of the total amount is generated from interest alone, with only 24% coming from your contributions. The key takeaway is that real gains come at the end of the journey, not at the beginning. And reaching your first £100,000 is rarely due to investment returns. In fact, it's quite the opposite. It all depends on how much you contribute. With all of this in mind, here is what I've been doing since I started investing to reach the £100,000 milestone. But before we dive into the next section, please do me a huge favor and hit that subscribe button. Thank you. Okay, so first of all, I opened the stocks and shares ISA and then picked a low-cost, globally diversified index fund. This approach is very important because it minimizes fees, maximizes diversification, and shelters investment growth from taxes, which can significantly accelerate gains over time. In case you didn't know, a stocks and shares ISA allows you to invest up to £20,000 per year completely tax-free. This means you won't pay any tax on the gains from your investments. Now, why opt for a global index fund instead of something like the S&P 500, for example? There are several reasons for this, but the main one for me is that the global fund provides exposure to all the investable markets in the world for a very low fee, including the S&P 500, the FTSE 100 and others. I prefer investing in a global fund because we can't predict where future growth will come from. And I like the idea of being positioned to capitalize on opportunities wherever they arise. Additionally, a global fund helps minimize risk by diversifying across all markets rather than concentrating on a single one like the S&P 500. But one of the most important factors for me is that I like to keep things super simple and put in as little effort as possible without worrying about rebalancing my portfolio and so on. This approach allows me to do that while knowing that I'm invested in literally everything. When it comes to the global fund I invest in, I've been buying the Vanguard Global All Cap Index Fund since I started my investing journey many years ago. The reason for this is that this fund was the most appealing option available when I started. I know that there are now many cheaper alternatives, but I've chosen to stick with this fund out of convenience. I know that I might be sacrificing some returns due to higher fees over time, but I really like this fund because it invests in over 7,000 stocks from around the globe for a very low annual fee of just 0.23%. It also includes emerging markets and smaller companies too, that have the potential to outperform in the long run. So essentially, I'm willing to pay a slightly higher fee for the potential of higher rewards over time. And I'm comfortable with that. The second step is probably the most challenging. increasing your income so that you can boost your investment contributions. As you saw earlier, the first 100K is the hardest to reach because a big chunk comes from your contributions rather than the interest earned. That means that to be able to speed up this process, we need to be able to invest more money year after year. Believe it or not, simply investing in an index fund will not make you rich. The key factor is the amount of money you contribute. For instance, if we increase the initial £300 contributions from the earlier example by 3% each year to keep up with the average inflation rate, the time required to reach the first £100,000 is reduced by about 2 years. Over the entire 30-year period in this scenario, you could potentially accumulate £600,000. That's a £150,000 increase simply by raising your investment contributions by just 3% each year. To further enhance this strategy, I personally focus on reinvesting dividends, as this single factor can significantly accelerate your journey to £100,000. Therefore, finding ways to boost your income and redirecting any extra cash flow into your investments can dramatically reduce the time it takes to reach your first £100,000 target. So how do you do that? Here are 3 strategies you might consider. The first option is to pursue pay rises at your current job, or if that isn't feasible, consider switching jobs for a higher salary. This is likely the most immediate and straightforward method to boost your income. Another way to generate additional income is by making adjustments to your lifestyle, such as cutting expenses and striving to live below your means. However, this approach has its caveats. A lot of financial advice revolves around the frugal mindset, but I don't fully agree with the idea of depriving yourself of enjoyment solely for the sake of saving more money, because what you gain financially can come at the expense of life experiences. If you become overly fixated on spending less and saving more, it can turn into an unhealthy obsession, whereby living for today can easily be replaced by living for the future. This could lead to a situation where the future never actually arrives, becoming a permanent state of waiting. Rather than restricting yourself to the point of unhappiness, it's better to be smart about how you use your money and to make small adjustments in certain areas of your lifestyle and spending habit. The idea is to find where the biggest cost in your lifestyle is and find a way to get the same for less. For instance, if you're looking to generate more income, you could consider relocating to a more affordable place. Personally, I don't want to focus entirely on saving and investing while neglecting to enjoy the present. While securing my financial future is crucial, I also recognize the importance of enjoying my life today. So the key here is to find a balance. The final option you could explore to generate additional income outside of your day job is to start your own side hustle. You can achieve this by identifying your skills or passions and finding ways to turn them into a business. Now, you'll notice that I haven't mentioned anything about finding investments with a bigger return. Many people become overly focused on chasing an extra 1% or 2% and end up complicating their investment portfolios to the point where investing becomes a burden. But the key to driving results is increasing the amount you can invest, rather than trying to optimize for the best returns, which, let's be honest, is largely beyond our control. While there are many rules you could follow, my approach is simple. I ignore the returns the stock market might offer, since I have no control over them, and I concentrate on increasing my contributions. That's all there is to it. The final step in my plan is to consistently apply the second step year after year while ignoring everything that occurs in the stock market and the wider investing landscape. No one likes seeing their investment accounts in the red, but the truth is that market fluctuations happen more frequently than you might expect. On average, since 1980, the stock market has experienced minor corrections of about 5%, roughly 4.5 times per year. In that same period, more significant corrections of 10% or more have occurred approximately every 1.2 years, while major crashes of 20% or more have taken place every 5 to 6 years. However, this chart shows us that if we simply remain invested, once we surpass the 10-year milestone and approach the 15 to 20-year range of investment, you'll find that there isn't a single continuous period during which you would have incurred losses in the stock market. Even during the worst 20-year period analyzed in this example, you would still have made 6.4% per year on average. Whereas during the best 20-year period, you would get all the way up to 18% per year on average. So as much as your gut is telling you that staying invested when the market is down is a bad decision, remember that timing the market will eventually win. Those are the 3 steps I've been following for years, and they've really helped me get closer to the first 100k milestone. And I plan to keep using the same strategy for the rest of my investing journey. I've personally managed to do this consistently over the years because I found out that there are 3 important things you need to know about investing. Once you understand these 3 facts, your whole mindset about long-term investing changes completely. We touched on one of them briefly, but there is more to it. So check out this video to learn about these 3 key investing facts. See you there.